Let's talk about 2026. This was the year the world's biggest bets on technology, on resources, on global stability all came crashing together. It wasn't defined by just one thing, but by a powerful, almost violent collision of forces. And the very first tremor of that collision? It started with a single, massive number, a quiet warning of a crisis that was brewing deep within the physical foundations of our very digital world.
10 million. Before the headlines were screaming about conflict, this was the number that really defined the tension bubbling under the surface in 2026. It pointed to a silent crisis, a huge crack forming in the very foundation of the global economy. So, what critical resource were we talking about?
That's right, a projected deficit of 10 million metric tons of copper. The metal that is literally the circulatory system of our modern world. A huge S&P Global study flagged this early in the year, calling it a systemic risk. Why? Because every single AI data center, every electric car, every piece of advanced military tech, it all runs on copper. We were staring down a massive shortfall, and get this, that was before demand truly went into overdrive.
So what was driving this incredible demand? Well, the single biggest driver was the first great force of 2026, the AI revolution. And as everyone was about to find out, this revolution wasn't just happening in the cloud. No, it was creating an unbelievable physical investment boom right here on planet Earth.
And you've got to understand how JP Morgan was framing the year. They saw these three forces as completely intertwined. You have AI's incredible promise, which was putting unprecedented pressure on physical supply chains. Then, those same supply chains were already getting squeezed by global fragmentation, the world basically splitting into competing teams. And all of this was happening while inflation just wouldn't quit. It was truly a perfect storm in the making.
And this right here puts a hard number on that boom. U.S. tech capital expenditure, that's the real money companies spend on physical stuff, was on a trajectory to blow past $500 billion. And this is the key takeaway. This digital revolution has very real, very physical demands. Every dollar spent on some amazing new AI model translates to a physical need for more data centers, beefier power grids, and more raw materials being pulled out of the ground.
All this physical demand brings us to our second major theme, which Goldman Sachs perfectly named the power race. The global competition wasn't just about who could write the smartest code anymore, it was about who could get their hands on the raw materials and the energy needed to bring that code to life. Now, these were the forecasts before the conflict, and the data is crystal clear. Analysts saw massive upside in the metals that are essential for electrification and computing. We're talking gold, silver, and of course, copper. At the same time, they saw oil prices staying pretty tame, all based on the assumption of a stable geopolitical environment. Well, about that assumption.
And this quote from Daniel Yergin just nails it. The world was banking on this massive technological leap forward, but that leap depended entirely on a supply chain for a metal that was already stretched to its absolute limit. You can see where this is going, right? The stage was set for a major shock.
And then it happened. The shockwave hit. In late February, a sudden geopolitical conflict erupted, and it collided head-on with every single pressure point we've just talked about. Okay, and just a quick but really important note here. What we're doing is a historical analysis, it's not investment advice. Because as we are about to see, all forecasts are vulnerable to the kind of unforeseen shocks that can just change everything overnight. The market reaction was just immediate and violent. February 28th, the strikes begin. Not even 24 hours later, gold surges as investors scramble for safety. A day after that, oil markets completely convulse as the Strait of Hormuz, a choke point for about a fifth of the world's oil, is directly threatened. And just 1 week in, the impact was already hitting gas pumps all across the United States.
So this conflict didn't just create some temporary panic. Not at all. It fundamentally ripped up the economic outlook for the rest of the year, amplifying the inflation and fragmentation trends that were already bubbling away.
And the data lays out the consequences in stark, black and white terms. Even a brief disruption would slow down global growth and make everything more expensive for everyone. But a sustained conflict? We're talking just 5 weeks of disruption in the Strait of Hormuz would be so much worse. It would wipe nearly half a point off global GDP and add almost a full percentage point to inflation, pushing the entire world economy right onto a knife edge.
And this right here is the most critical takeaway from that entire year.
The conflict didn't get rid of the underlying pressures from AI demand and resource scarcity. It poured gasoline on an already raging fire. All of a sudden, that power race for copper and other critical materials wasn't just an economic competition, it was a national security emergency. And the slow fragmentation of the world into competing blocs, that became a hard, sharp, and sudden reality.
The events of 2026 were a brutal stress test for the entire global system. They exposed these deep vulnerabilities where technology, resources, and geopolitics all smash into each other. And it leaves us with a critical question, not just about the past, but about our future. In an era that's going to be defined by these powerful, colliding forces, how do we build a world that's actually resilient enough for what comes next?